How can you protect yourself from dodgy investments? Hi, I'm Phil Muscatello, and this is the Shares for Beginners podcast. Now, this episode is based on a recent episode of the podcast with Vince Scully from Life Sherpa, where we covered the collapse of First Guardian and Shield Master Fund. Now, this is a pretty major failing of the Australian financial system, where we've got about 12,000 Australians who are now out of pocket for over $1 billion. But we covered what was going on here with this fund and how you could maybe have a look in the future as a warning for what you would be putting your money into, okay? Now, wherever you are in the world, your superannuation here in Australia, pension funds in other parts of the world, 401k or Roth IRA, these are mostly invested by fund managers in mutual funds, managed funds, ETFs, all kinds of funds. A fund is just a vehicle that's set up basically to manage a pool of money on behalf of investors. And you want to make sure that your money is not going to end up in some sort of dodgy fund that's going to collapse. So there were some warning signs, and I just wanted to go through them here. Okay, let's have a look through what happened with these funds. First of all, there was a lot of hard selling techniques to get people to sign on. Now, this is red flag number one. You shouldn't feel pressured to put your money into any kind of investment. So what happened was that these were advertised on places like Instagram and other social media sites, and it was a lead generation tool so that investors would be asked the question, do you want to make more money out of your pension plan, your retirement plan, your superannuation? This is red flag number one. I mean, everyone is going to answer yes to that question. So they clicked on the link and someone would give them a call and have a chat to them and start talking about a particular investment that these people should be considering for their investment portfolio because they were getting promised higher returns. There's red flag number two, higher returns, because they were offering safety, almost a risk-free investment as well, if you will. Risk-free, that's great. I love that. In fact, what was happening, these funds were actually spending money all over the place in not so many good ways. First up, a lot of the money was wasted on paying for Floyd Mayweather, the ex-boxer and promoter, to come out and talk to people investing in the funds. There were Lamborghinis being purchased by fund managers, and then there were a lot of related party transactions. Now, related party transactions carry a conflict of interest. In this case, the conflict of interest was about the spending of money to a related party who was marketing this scheme, the very marketing operations that were fishing and drawing in new investors to invest in these funds so that the fund managers, they could then spend the money on boxes and Lamborghinis and other related party transactions. Now, the other related party transaction, which was of concern, was into real estate developments. Now, this is like giving your friend money from someone else that you've taken and giving it to them, even if you haven't done the due diligence to make sure that it is a good investment. Now, I just want you to think about all this for a moment, okay? We've got a fund that's marketing itself as providing above average returns, but investing your money safely. These things don't sort of add up, okay? So like a traditional portfolio is known as a 60-40 portfolio. So it's 60% in equities, 40% in fixed income. Now, there's a limit to the returns that can be generated by a fund like this. It's basically going to be realistically offering something like 5 or 6% per annum return. But these funds were promising up to and over 9% per annum. Now, there's a red flag straight away. If you're being offered a conservative, balanced investment, you shouldn't be expecting returns, above 7%. There's a red flag. The high-pressure sales tactics, That's another red flag. You shouldn't be getting pressured into putting your money anywhere. The third red flag, now if you went onto the social media account of some of these managers, you would have noticed there was a lot of flash pictures of, you guessed it, MMA fighters and Lamborghinis. There you go. There's another red flag. So it's impossible to completely avoid these, especially when you've got a regulatory structure around these investments that are supposed to be looking out for your interests. But they're not going to, you've got to do a bit of due diligence yourself, because this is all self-directed. These are not investments that were provided without the consent of the people that lost their money. These were self-directed. They themselves were pressured by salesmen who said, get a better return on your super and it'll be managed safely for you. But it didn't happen. Another thing that comes out of this is lack of transparency. And keep in mind that when your money is being invested, it's going to be invested in some assets which are more liquid than others. Like, a stock on the stock market is very liquid because it can be bought or sold at a moment's notice. However, if your money is being put into some sort of real estate investment, directly in that real estate investment, first of all, it's very hard to value what that investment is. And secondly, if there's any trouble, it's very difficult to get your money back at short notice. I mean, you just can't sell an office block straight away or, an office block brick by brick. It just doesn't work that way. So be really, really careful and look deeply into the prospectus to see where your money is going. Now, in Australia, we've got a thing called a statement of advice. Now, I'm not sure what it's like in other countries, but this is something that's a very large document that's required by regulators to make sure that you, the investor, are fully aware of what's going on. But of course, many investors don't read it because it is very, very large. It has to be written in a style that is easily accessible. So please read any documents that are related to whatever you're investing in. And just make sure if you have any questions, you can always ask your advisor or your pension fund provider about what's going on. It's your money. Make sure you do your own due diligence. It's worthwhile investing in funds that have got a long track record and are of a certain size. There are many funds that are very small, and you don't want to be in those kind of smaller funds. I mean, just for your own safety, maybe just go for bigger is better in this case. Ask about conflicts. If you're being advised by a financial advisor, or if you're getting sales calls pressuring you to invest in a particular vehicle, ask them, what do they get out of it? I mean, in this particular case, if you look deeply into these investments, you'll notice that the costs were $3,300, out of which, and this was fully disclosed, $2,200 was going to a company that was actually marketing these products. Just so think about that the money you are paying for this particular piece of advice, most of it is going to the company that has marketed it to you. This is definitely a conflict of interest. So just to sum up, if you want to avoid dodgy investments like this one, stay vigilant, ask questions, and don't be afraid to walk away from anything that just doesn't feel right. Okay? Anyway, at the end of this episode, there'll be a link to the full episode where you can hear Vince and I talking about this particular case. We go into a lot of depth about this. Vince tends to go into a lot of depth on many occasions, but he's a great font of knowledge. Don't forget to have a look at that. And Life Sherpa, because Life Sherpa, let's face it, is Australia's most affordable financial advice.